Hey, everybody. Welcome back to the Startup Sense podcast. This is your host, Jonah Lupton. Thank you so much for joining us today. Greatly appreciate it. Okay, so today's guest is a guy named Daniel Schreiber. He's originally from the UK. He is now building a company by the name of Lemonade, which is kind of an unusual name for an insurance company, but we're going to jump into that in a second. Lemonade is based in New York. They've raised about $60 million. They just closed on a $34 million B round in December. Company's about 30 people, I believe. And let's welcome Daniel. Daniel, how are you, man?
Excellent. Good to be with you.
Thank you for joining us. So before we talk about Lemonade, just give us a little background on yourself. What were you doing before you started this company?
Sure. So I've been in tech as a serial kind of entrepreneur and intrapreneur for the last 20 years, but I started life as an attorney. I trained in the UK. You're right, and that's where I'm from. So I consider myself a recovering attorney, but I've been in tech for the last 20 years.
Okay, cool. So when did you start this company, Lemonade?
So my co-founder, Shai, and I started it about 18 months ago.
Wow.
Yeah, we had done a couple of things along the way, and we were looking for our next kind of big gig. And when we stumbled across insurance, about which neither of us knew anything, we felt, paradoxically, that this was something that was going to be a good fit. The idea of kind of this huge industry in every household in the nation uses insurance in one way or another, and usually in multiple ways. So this huge industry, both huge in terms of the dollar amounts, it's a multi-trillion-dollar industry, but just in terms of its reach, every person needs it, which is largely untouched by innovation. I mean, this is a sector that has been largely unchanged in 100 years. The largest insurance companies in the nation are all like 100 plus years old. And we love that as entrepreneurs, idea of taking on an industry that is huge, but also unspoiled by innovation, untouched, unchanged in so long is very tempting. And the final piece is not really much love for this sector. So you find a sector that is huge, unchanged, and unloved, and that's kind of the holy trinity for an entrepreneur. So we dove in.
Okay, so that's a good question, right? Because a lot of entrepreneurs, I think there's two types of entrepreneurs. One that spend a lot of time in an industry and then start a business in that industry because they have some sort of expertise or they think they can do it better for whatever reason. And then there's guys like you that see a huge industry they know nothing about and they still decide to jump into it. So, I mean, how did you guys kind of gear yourselves up for that? I mean, did you have to become insurance experts before you got started, or just knew that with technology you could do something different?
Yeah, for a long while, for several months before we really got going, we cherished our ignorance, if you like. We kind of really protected our naivete. And even though we decided this was a sector we wanted to go into, we did not swat up on it. We didn't read up on it, and we didn't talk to anybody in the sector. The reasoning being that it's very difficult to reconceptualize something that you know intimately well. The challenge of rethinking something that is so familiar is really daunting. And it's easier to come in from the outside, a cross-pollination of ideas, saying, look, we understand technology, we understand disruption, we understand sharing economy. How would we build insurance today? Knowing just high school level probability theory and, common concepts from insurance, but nothing beyond that. And we locked ourselves in a conference room. We took a room and we had a whiteboard, and we started whiteboarding out what we thought insurance should be like. And that allowed us to soar into areas that once we confronted reality, we found we traveled a fair distance from what insurance is like today. But it allowed us to put down things like transparency, like avoiding conflicts of interest with our customers, like using technology to not only to lower expenses dramatically, but to expedite the process and make it delightful and playful and instantaneous. And we did a lot of work with game theorists and behavioral economists to try and create a construct of insurance that allowed the insurance company and its customers to be on the same page rather than fighting each other for the same coin. So that was a multi-month process of us working and taking full advantage of our ignorance, milking it for all it was worth. And only after that did we go out and say, okay, now let's confront that with reality. And we started speaking to regulatory experts, to other insurance experts, and to begin to put the team together.
So when did you guys actually start assembling the team? And I assume that you guys had to hire a lot of engineers in the beginning to build these algorithms, right?
Yeah, so we started around June of 2015.
Okay.
And we started speaking to investors around then. We closed a seed round that summer, July, August. It was an unusual seed round. It was a $13 million seed round led by two funds, Sequoia and Aleph, and it was the largest seed in Sequoia's history. But insurance is unusual in that regard, and it does require more capital, and it's kind of a big, audacious, hairy goal that would set ourselves to take on this huge staid industry. So we did require quite a lot of capital. And in and around that time, we put together the basic team as well.
You guys aren't underwriting the policies, are you? You're still kind of acting as a broker?
No, we're not. Rather, we're not acting as a broker. We are a full stack, standalone insurance company. This was part of what we did is, I mean, we can elaborate on this in a minute, but in our way of thinking, the ills of the industry or the malaise that afflicts the industry runs pretty deep. And the solution to the problem of why do people hate insurance isn't because there's no app. It goes a lot deeper than that. And we've really figured that the only way to reinvent and to change the end user experience is to start with the fundamentals. And that really required a different kind of insurance company. We didn't think you could pixie dust style, sprinkle technology on top of a 100-year-old edifice and expect the results to be dramatically different.
Interesting. Okay, so I did not realize that. That is a fundamental change, certainly in the entire industry. Then, so how did you guys approach the fundraising? I mean, like you said, Sequoia, biggest seed round, or the largest seed round they've ever led or gotten involved with. Did you have relationships with them prior, or was it through an introduction, or how did that come about?
No, we didn't have a relationship with them. We knew that we'd have to raise an unorthodox amount of money for a seed round, just given what we were setting out to build. But at the same time, the things that excited myself and Shai excited investors as well. So the idea of rebuilding insurance from the ground up, creating a new structure, taking on board an industry that is trillions of dollars big, but has been immune or kind of left alone by all the transformation of the last 100 years. So, some use of computers, but nothing deep had changed there. So I think for investors, the idea that you could take on as big an industry as that using the kind of tools that we had familiarity with and had used in the past was very tempting. And it wasn't too difficult. Shai and I are relatively older for entrepreneurs. We're in our 40s, not in our 20s. And we've done some things in the past, and the combination of that and the team that we were able to put around ourselves, the president of product from AIG joined us, Professor Dan Ariely, one of the leading scions of behavioral economics, joined us, and some other people. We were pretty quickly able to put a very strong multidisciplinary team in place, and that gave some confidence that we might be able to pull this off. So it was a combination of the prize being big enough and their assessment of our chance of success being big enough, and the rest kind of played along.
I mean, obviously, if you guys get this thing right and you hit a home run, I mean, that it's well into the billions. So, I mean, it makes sense that, a venture fund would be willing to take a chance early on. Let's talk about building the business. So how do you guys acquire your customers for the most part? And how do you convince them that kind of artificial intelligence is good for them? I mean, how does the customer win?
One of the challenges of starting a company like Lemonade is that it is in a heavily regulated industry, and that meant that until we got our license to operate as an insurance company, we couldn't really test anything. We could do stuff. We could show people kind of a user interface and test kind of in very artificial environments, but we couldn't really do the Silicon Valley approach of create a minimally viable product and then iterate. We had to get it to a level that it would pass muster with the regulators. So when we launched, we weren't sure whether the customer was going to like it, whether the dog would eat the dog food. And one of the big reliefs that we experienced was that everything that we'd worked on and poured our heart and soul into resonated with consumers. People were kind of waiting for this. There is this reservoir of ill will towards the insurance sector, I think well earned by the insurance sector, but there's a reservoir of ill will. And as soon as we came out with a message that we're a B Corp, we give underwriting profits to nonprofits, we take a flat 20% fee, so whether or not you make a claim, we're never going to make more, we're never going to make less, and that means that we're not in conflict with you. We're not going to fight you over the same coin. And as soon as you play with the app, you go to lemonade.com or you download the Lemonade app and you just experience it, we find a lot of people almost buying it as an impulse buy. They just be curious, try it out, and boom, wow, $5? Okay, I'll do that. What we found is that 87% of our customers never bought insurance before. So, yeah, we have people who are coming to us and leaving Geico and USAA and State Farm and Allstate and Liberty Mutual, all those guys, but a huge percentage, a surprising to us number of people, are non-consumers. We're appealing to a whole sector of society that just isn't engaged with insurance today. So how do we get to them? Through a combination of things. Word of mouth and press has played an important role. We're seeing a lot of our customers become advocates. So we're seeing a lot of people tweet about their buying Lemonade insurance or do other kind of social media postings, which is pretty remarkable. People, generally speaking, don't tweet about the fact that they just bought insurance.
Definitely not.
So we're seeing a lot of virality and word of mouth. And then we're doing, that Google AdWords and stuff like that as well to give that a boost. But most of our customers are coming in organically, not through any of those channels.
This is Jonah Lupton, founder of the Lupton Group and host of the Startup Sense podcast. Are you struggling to find the right tech team to build your company's website or mobile app? Maybe you've developed a product but need help with your go-to-market strategy, including branding and marketing. Well, stop worrying, because my team at the Lupton Group can assist you with all of those needs. We specialize in helping entrepreneurs and startups of all sizes launch and grow their businesses. For a free consultation, you can email me at jonahlupton@gmail.com or visit our website at luptongroup.co. So on the website, you guys have a kind of a chart or graph of the percentage of your new customers and which insurance companies they're coming from, and you rattled off some of them: Allstate, State Farm, Travelers, Geico, et cetera. Have you guys heard why most of them are switching? Is it mostly because of price? Is it just because you guys are kind of new and sexy and doing something different? I mean, what have you been hearing from customers?
A combination of things. There's really kind of two aspects to our core message, if you like. We talk about Lemonade as being built on artificial intelligence and behavioral economics. And those are really the two pillars that resonate with people. So artificial intelligence is just a short form for a digital experience. I've seen people tweet about how thrilled they are that they could buy insurance in their pajamas at home at 2 o'clock in the morning.
Right.
And we become, as consumers, that's what we used to, right? We don't want to have to meet a broker in order to buy stuff. We don't have to go to the store. You can just buy on Amazon. And what used to be perceived, and what I think insurance companies still think of as a degradation of an experience. Oh no, instead of a person, you're going to have to speak to a computer. They think that is a degradation of their experience. But for most of our consumers, it's the other way around. Speaking to a person is a pain in the neck. I'd much rather be able to just interact with a screen and get it done on my terms, at my time, and my convenience. So that's part one, is a process that is streamlined, asks you a short number of questions, gives you an incredibly easy quote, low price. Almost always for renters insurance, particularly, it can be dramatically lower than those other guys. I mean, I'm talking 70, 80% lower. So, there can be oftentimes huge savings, and I'd love to explain to you a bit about why that is.
Yeah, please.
But I don't think people come because of the price. They come because the experience is transformative and it's delightful. And then the second piece is the behavioral economics. People want to feel like there's an insurance company that isn't in conflict with them, that doesn't make money by denying their claims. The idea that underwriting profits go to a nonprofit of their choosing can be transformative as well. So it keeps us honest because we don't have any incentive not to pay our claim, which is why we're able to pay pretty quickly. We set a world record. We paid a claim in 3 seconds, just algorithmically. That's a combination of the AI and the behavioral economics. But it also means that you as our customer are more likely to behave yourself, to be more circumspect when you're making a claim, because we remind you, we say, hey, Jonah, you chose whatever, the local church or your kid's high school or whatever it is that you chose for what we call the give back. That's what we've designated as the places like the underwriting profits to go to. And we say to you, hey, please claim whatever you want, but please remember that unclaimed money is going to this cause that you've selected. Whoa, that changes things. Now you're not ripping off some big nameless, faceless behemoth institution with whom you have an adversarial relationship. Suddenly you're thinking, oh, 1 second, this is different. I'm going to be a bit more cautious when I'm making my claim. I'm going to be a bit more honest. And fraud is a huge problem in insurance. So if we can raise the level of trust, you trust me more because I don't make money by denying your claims. And I trust you more because you don't want to screw over this cause that you've designated as being important to you. And then instead of suspecting that everybody's being fraudulent and just assuming that everyone's bad and has to be have to throw paperwork at you. I can flip that and say, no, I'm going to assume that everybody's good unless proven otherwise. And then I can use technology to streamline the claims process where you can see how one begets the other, and before you know it, you're in an experience that is aligned, that is delightful, and that is instantaneous.
So now let's pretend I have a $700,000 house. I buy homeowners insurance through Lemonade. The house burns down. You guys make the claim yourselves? I mean, I put in the claim through you guys, and you guys would essentially pay me out?
Yeah, absolutely.
Interesting. Okay, let's talk about why you guys are so much cheaper than some of the competition. I have some guesses as to why, but I'd rather hear it from you.
Sure. Well, we aim to be cheaper across the board and just the ability to lower the overheads. Homeowners insurance companies in the U.S. spend on average 29.4 or 30% of every dollar that they collect on themselves. It's called the expense ratio, and it just means that's how much it costs me to run an insurance company.
Right.
I may spend it on commercials, on all different things, brokers, loads of things that I spend that money on, but 30 cents on the dollar going on myself. We think that is about 10 times higher than it should be. So we're looking to dramatically cut the expense ratio and to use software in order to displace a lot of those processes, not undermining the experience, but augmenting the experience as a result of that. But that doesn't get you to 80% savings. We're hoping to lower the fraud component. Nobody quite knows how much fraud is. Estimates vary that anywhere between 10 and 38% of the money in the system is consumed by fraud and fraud mitigation. I can't defend any of those numbers because it's underreported and nobody knows.
Right.
But clearly it's a sizable chunk, and if we can, through alignment of interest, can lower fraud, that would also save a bunch of money. But even if you add those two together, you're still not at 80%. What happens with with the renters insurance is anomalous, and I'll explain. Your insurance is typically priced by something called an expected loss. So actuaries work hard to divine how much Jonah is going to cost us on average every year. So we say, okay, you know what? People like him with this kind of a house, a $700,000 house, whatever it is, in this neighborhood, with this proximity to the fire hydrant and this exposure to weather patterns, they make a claim of $3,000 once every 10 years. Well, if I do that and I divide 3,000 by 10, I figure that your expected loss is going to be $300 a year. Now, in theory, that's how much I expect to pay you every year. In practice, I'm going to charge you more than that. I'll probably charge you $600 because I've got that expense ratio. I've got all those other things. I need to have some profits. I need some safety margin because I may get it wrong. So that's how I price it. I say, okay, I'm going to charge you 2 times your expected loss, in your case, $600. Now, that works for a condo owner or homeowner. $600 plus works, and condos tend to be around $500, $600. Standalone properties around $1,000 a year. The problem comes to renters. Renters aren't insuring their actual property, the bricks and mortar. They're only insuring their personal property, the stuff in the house.
Right.
And that can often be worth a tenth or even less of what a standalone home would be. Instead of insuring for $700,000, maybe you'll just be insuring for $20,000. So now it's a fraction. So suddenly my expected loss is no longer $300, maybe it's only $20 or $30 a year. And if I times that by 2, I'm meant to be charging you $60 a year. Now, in a traditional insurance company, there's no way I'm going to charge you $60 a year because it costs me $700, $800 to get your business. And I would go out of business if I started selling $60 policies and I spend 10 times that to acquire your business in the first place. So what insurance companies do is they say, okay, I'm not going to price, if Jonah's a renter, I'm not going to price him based on his expected loss. I'm going to price him based on my high costs. So you may pay $200 or $300 for an expected loss that's a tenth of that, $20 or $30. Because we don't have those high acquisition costs, because we can acquire customers for a tenth of the price of the incumbents, we don't need to inflict that high minimum on you. And if your expected loss is $60, we'll charge you $60, and that's $5 a month. So we're able to charge you $5 a month because we're getting much closer to your actuarial risk, and we don't have this very high minimums that we kind of bake into the policy, whereas the others are going to charge you 3, 4, 5 times as much, regardless of your expected loss. I know that's a fairly technical explanation, but I hope it helped show how using technology to lower the underlying costs can actually have disproportionate advantages to consumers, particularly renters. And 70% of 35-year-olds and under are renters. So this is a pretty big issue for a lot of the population.
No, I appreciate that, and I think many of the guests that I bring onto the show are disrupting industries because those industries, they've just been around for so long that they're still doing the same thing the same way, and there's just all these unnecessary levels of expenses and overhead, and in your case, insurance, some fraud and whatnot, and these new technology companies can come around and kind of start from scratch, rebuild the process, and just be way more efficient than their old legacy counterparts. So,
absolutely.
Talk to us about, I guess, what right now you guys are in New York and you have another office in where, Tel Aviv, you said?
Yes.
Why are you guys in there? Why are you guys in Tel Aviv? Or is that where most of your engineering is?
That's right.
Okay. So New York, expensive place to do business. Most of your investors are on the West Coast. Why did you guys set up in New York?
Yeah, it was between the two. We were a bit torn. And we filed within 24 hours of getting a license in New York, we filed to get a license in California, and that is the next big place that we want to launch. In fact, we've filed in 47 states, so we're hoping during this course of the year to get to most of the nation. But Silicon Valley was attractive for obvious reasons, and New York for obvious reasons. New York is the financial capital of the nation. It's one of the major financial capitals of the world. And ultimately, we're in the financial sector. So it did make sense for us. We were looking also for a tight kind of urban setting to launch in. And the New York regulators have a reputation as being particularly demanding.
Yep.
It is a tough regulatory environment. And we respect that. We didn't want to go to some place which is regarded as an easy way in and then have to convince other regulators to, that we're real, or other consumers that we're real. We wanted to go to the toughest regulatory environment. and it's a kind of the contrarian in us. And we wanted to see that what's the point of launching a product if it doesn't pass muster with the toughest regulators? So we took on that challenge and we went straight to New York, and it's a great privilege to be regulated by the New York regulators because they are, as I say, so very exacting.
I mean, I know you guys are still a young company, so you're still trying to remain laser focused on what you're doing, which is homeowners and renters. But have you guys thought about getting into other areas of insurance, like, car insurance or even life insurance, where you can apply your same, AI to it?
We have, and some aspects of that we'll already be doing during the course of this year. So we are focused, but there are also ways to slice and dice insurance, property insurance, we think that don't exist today. So there's a lot of opportunities that we're still exploring, and we'll look to launch our first forays into it later on this year. But just like we spoke about the fact that renters insurance for $5 a month doesn't exist given the current infrastructure of insurance companies and the legacy and heavily encumbered cost structures, we think there are whole other groups of products and insurance products that don't exist for that very same reason, because they may end up being $1.99 a month, and which insurance company wants to mess with that? Well, only a digital one. So absolutely, our goals are pretty expansive, both in terms of geography and in terms of product line, and we will be looking to launch multiple different products. We are licensed as what's known as a P&C insurance company, which means property and casualty. So we can do property insurance of different kinds. We're not licensed to do our own life insurance at the moment. That's not part of our remit.
Okay. Yeah, I spent a few years in the investment business, so I had to have all my insurance licenses. So you're taking me back to some pretty scary days when I had to pass all those tests. A lot of studying got involved. What's been the most difficult thing so far? I mean, you guys are, amazing traction. You've raised a ton of money. I mean, you've only been at this for a couple of years, but I'm sure you guys have run into some speed bumps. So what were a couple of them?
Getting the regulatory approvals was as demanding as we thought it would be. And for us, that was an existential question. We were determined to be a fully vertically integrated company, to do our own underwriting on our own paper and not be dependent on traditional insurance companies. So convincing the regulators of our novel business model, this idea that we would give back money to nonprofits, taking a flat fee, using technology to underwrite and pay claims, this was all very unconventional and took a lot of work, and the burden was on us to prove that we could really do it. And we had to do a lot of modeling. We'd take the results and the losses experienced during Sandy in 2012 and run that as a model through and demonstrate that we'd be able to pay all the claims and that we were financially responsible, and that the last thing that we want, but that the regulators are there to prevent, is that it'd be claims that we wouldn't be able to pay. So getting all of that in place was perhaps, if you ask me what was the single most challenging hurdle for us to overcome, it would have been that.
Okay. Yeah. I mean, that would certainly make sense, right? I mean, regulators are extremely difficult to work with, and you guys obviously started with the toughest state or one of the toughest states. So I can imagine that being difficult. Have you guys had any problems with hiring? Even in New York, right? I mean, there's a lot of capital, there's a lot of startups, there's a lot of competition. You guys are obviously looking for the best of the best. How difficult has it been finding those people?
In some areas, it's been very tricky, particularly in insurance. So we've got, for example, a chief underwriting officer, which is a very important position in an insurance company, was the chief underwriting officer of Liberty Mutual. Our head of claims was the senior vice president of claims at Chubb. I already mentioned the president of product at AIG. So we needed people of that kind of caliber to join us in order to satisfy ourselves and our investors, but also the regulators and the reinsurance companies that we work with, that we know what we're doing. I spoke before about celebrating our naivete, and that takes you only so far. At some point, you also have to balance that with real experience and expertise. And that is a challenge when you're a startup with just a handful of people sitting in an open space in jeans and flip-flops, and you want to entice people away from huge salaries in the private jet and thousands of employees that work for them in these large, established and safe insurance companies. That is hugely challenging. And then to make a culture that can work with the guys who grew up on technology, the young millennials, those kinds, together with people who are twice their age and have spent the last 30 years in large insurance companies. So it's been a huge challenge to build that kind of multidisciplinary team that can really reinvent insurance and find those few diamonds in the rough. There's people who are inside big insurance and yet able to think independently of it and to cut off the branch on which they're sitting, so to speak. When we were hiring for those positions, I literally put in the job description that one of the requirements for the job is a midlife crisis. If somebody came along and they were happy in the corner office, they weren't for us. I needed somebody who's going through this thing of, what the hell am I doing with my life? Why am I in this industry? Looking for an opportunity to reinvent themselves. So we've got a motley crew of seriously experienced and badly scratched insurance executives leading our team.
That was me 5 years ago. So I wish I had found you back in 2011. When I did, I kind of had my, not necessarily midlife crisis, but maybe like my quarter life crisis, and spent 9 years in the investment business and just felt like I needed something different. I wanted to be in the technology business. I just got sick of the old, stale way that wealth management was being managed. And I think that's one reason that these robo-advisors and now AI are becoming so popular, bringing technology to these old businesses, these old industries. Where did the name Lemonade come from? I mean, it's just, lemonade. Don't put that to insurance, but there must be a good reason behind it, right?
Yeah, it was my co-founder who came up with it, and I loved it straight away. It's a play on when life gives you lemons, make lemonade. Okay. And it also it was just great because it engenders these kind of questions. I keep getting asked this, and it just means that we're different. We're not using the kind of name that you'd expect from an insurance company. It's memorable, it's irreverent, and it's a little bit cheeky. And I guess that encapsulates what we're about.
What are your number one goals or top two goals for business with regards to Lemonade in 2017?
We're growing every day, which is great, and we're getting all of our ducks in a row for national expansion, which is a big part of what we have to be working on now. Moving from one state to close to 50 is going to be hugely challenging for every part of our organization. Also, the way regulation works in the insurance sector, it's on a state-by-state basis. So it's almost like expanding to 50 countries. So that's a big part of it. Another part of it is we're still in trial and error mode on a lot of our product initiatives. You asked me about different products that we'll launch. So we're doing a lot of testing and seeing what consumers like and what works best for them. So I think the next few months are still going to be growing, and we've been growing pretty quickly. We've been growing 300% month on month.
Wow.
But the focus more on building out the infrastructure right, getting the license regulatory environment fleshed out so that we can continue that kind of growth. And completing some of the tests that we still need to do and refining some of the product stuff. So, we find as we go through every stage, every version that we release, we find different customer requests coming through. We get a lot of customer interactions, and that really drives for us what the product iterations have to look like. So what is being asked for the most, and then pushing that down into the product. So a lot of that's still ahead of us. We're still a young company.
How many people did you end 2016 with in terms of employees?
I don't have that top of mind, but it must have been around 20, I'm guessing.
Okay. So, you guys are probably going to do some serious hiring this year. What types of people are you going to be hiring in case anyone's listening to this podcast and might be looking for a job and going through a midlife crisis and lives in New York? Are you guys, it sounds like most of your engineers are over in Tel Aviv. So is it mostly going to be like marketing people, customer support, biz dev?
Yes. We are hoping, in order to continue to keep the costs low, we are looking to do a lot of this through software, not, if we're going to grow tenfold, we don't want to grow our headcount tenfold, otherwise we haven't done anything really. So we aren't looking to hire aggressively, but we do need to. We do need some people in the insurance sector as we grow. We're going to need people in all of the disciplines that you mentioned. So absolutely, business development, marketing, customer support is a big issue for us. So absolutely.
Which of the marketing channels, I know you mentioned before that kind of word of mouth and some press have been really crucial so far in the early days. But as you guys get more into, paid customer acquisition, whether it's on Facebook ads, whether it's LinkedIn ads, whether it's SEO, whether it's content, and then promoting that, do you guys have a feel for where you're going to find your customers outside of word of mouth?
We do. At this point, we've got quite a lot of data on that. It will be hugely valuable to our competitors. So with your permission, we'll keep that close to the chest.
Okay. Yeah. I can appreciate that. What advice would you have to someone else? I don't think most of us necessarily dream about getting into the insurance business. If they're listening, they have an idea now of how hard it is, right? How much money you need to raise, how much regulatory, BS you kind of have to go through. But just in general, for someone getting into software or looking to develop some sort of AI for another industry, what would you tell them? What have you learned in your journey that you can share with us?
I'll try to answer your question, but I'll tell you I'm leery of these kind of things, largely because we still, ask me that question again after we've made a success of this. I still see this as early days, and the burden of proof is still on us. We're taking on something hugely ambitious, and we're hopeful, and we're being supported by a lot of great investors and people, but I'd feel more of an authority on that once we're able to pull it off. The only thing I will say, though, that I found true to this point at least, is a couple of things that we've kind of lived by. One is that 10 times is easier than 10%. What I mean by that is, if we were endeavoring to do what everybody else does, what Allstate and State Farm and Liberty Mutual and all these names, if we were trying to do what they do but do it 10% better, we'd fail. That sounds like, you're not aiming so high, you're only aiming for a 10% improvement, but actually that would be a hugely ambitious thing to do. I don't think we could do that. Paradoxically, aiming to do something 10 times better, we actually have a better chance of success. Because if you go into that kind of 10 times mindset, I mentioned before the expense ratio, we don't want to lower it from 30% by 3% to 27%. That's a 10% improvement. We want to lower it down to single digit, down to 3, 4, 5%. Well, as soon as you set that as your goal, it's clear that you're not playing the same game as the incumbent. You're going to have to go back to the drawing board and rethink stuff. And actually, it is more realistic and less risky to aim for a dramatic overhaul than to think that you're going to beat the incumbents at their own game. Somebody told me ages ago, they said, if you want to beat Kasparov, challenge him to a game that isn't chess. And it's that kind of thinking that I think has been very important for getting us to this point, at least, which is we're not playing the same game as the others. This is an entirely different sport. And the 10x rather than 10% has been instrumental in getting us to this point.
That's so funny that you say 10x because myself and three other people are launching a group called 10x. And the idea is if you want to, it's actually called 10x3. And our thinking is if you want to grow your business 10x every 3 years, you need to be 10 times better than the competition. And that kind of fits into exactly what you said. I mean, you guys are completely transforming an industry. So I think what you just said makes all the sense in the world. Kind of last questions, I guess, before we wrap up here. I mean, you have some amazing investors in the company right now. General Catalyst, GV, which is Google Ventures, I assume, Sequoia, Thrive. I mean, any of us would love to be sitting at a table with any of them and get some advice. But what is some of the best advice you've gotten from your investors so far?
Well, you're right. We've been blessed with a wonderful lineup of investors. And I think that one of the things that they've given us by way of advice, and that is what makes them such good investors, is they're not short-term. You know, I was always nervous that the pressure for the near-term results would hamper our ability to really build a great business going forward. And there are investors who are less successful and less experienced than the roster that you just read out, who would sit on a CEO's the stream and just constantly say, oh, you know, what's the sales list today? What are the sales today? What are the sales today? And one of the things that our board has guided us time and again is we're building here, we're endeavoring to build a real franchise, a real brand, a real alternative to what is a huge incumbency. Focus on that. And they've just been so supportive on us doing things right rather than just gaining near-term kind of wins and sacrificing building the brand for just quick conversion, etc. So that I think has been both great advice and is one of the reasons that they're such great investors.
Awesome. Last question I'll give you is, you know, you guys are a fast-growing company. You've raised a bunch of money, but you know you still have to look at the bank and consider kind of burn rates and whatnot. So how do you balance that? You know, growth and profit. I mean, how much of that is that on your mind, not to burn too much money too fast?
It is. It's really on our mind. And actually, one of the things that it sounds like an awful, almost a conceited kind of concern to have, but one of our concerns was that we're raising so much money that it will spoil us. It's hard to retain the frugal, hungry, shoestring kind of discipline when you've got $60 million in the bank. So that is a key part of our discussion, and we try very hard to kind of lock away $50 million and pretend we don't have it. And you know, you asked me before about hiring, or you know, in other areas, we do try to do that because it's so easy to get into bad habits early on in your life when cash is not a problem, and fundraising in today's climate has been relatively kind to us. So. We're very focused on unit economics, on making sure that our cost of customer acquisition makes sense in the long run, not getting upside down in our economics, not thinking that we can just grow our way out of any challenge, but making sure that we're building a sustainable, profitable business that makes sense to our customers, makes sense to us, and ultimately will make sense to our investors.
Awesome. Well, let's end it there, man. Really, really want to thank you for your time today. Greatly appreciate it. I'll get this podcast posted tomorrow. Where can we find you online? Where can we connect with you and learn more about the company?
Lemonade.com is perhaps the best place for the company. I'm on Twitter as well. I'm D.A. Schreiber. I'm at D.A. Schreiber on Twitter. We've got a blog that's pretty active on lemonade.com. On the top left, there's a blog post, and we've actually done quite a lot of posting of our results. We have something that we call the Transparency Chronicles, and we posted 4 fairly detailed posts on our results, on our customer acquisition challenges, on the demographics of our consumers, on our growth curves, on the charities that we're working with. We think that in order to engender the kind of trust that we're hoping to engender, we have to be unusually transparent about those things. So that's all there as well for you to read. I think you'll enjoy that.
Yeah, I'm on the blog right now. It does look pretty interesting. And then for anyone interested in possibly working for Lemonade in the future, do you guys have a jobs board anywhere?
We do post every now and again. You can look at us on Facebook or LinkedIn. It's probably the best places to get in touch.
Okay, perfect. Well, thank you so much, Daniel. I really appreciate it. I want to wish you the best. Sounds like you guys are off to a great start in 2017. Hope it continues. And feel free to come back and talk to us anytime.
Wonderful. Thanks, Jonah.
You got it, man. Take care. Bye.